In this video, Ed Yardeni shares his shifting perspective on small cap and mid cap stocks as the market enters what he refers to as the roaring 2020s phase. Initially skeptical, he now leans towards a more bullish outlook, particularly on mid cap stocks, which he believes are demonstrating stronger earnings performance compared to small caps, which he views as overvalued.
But I think this market is broadening out. I think we've got a roaring 2020s kind of bull market here, and valuations clearly are stretched on the larger caps, and the mid caps are looking more interesting, particularly the mid caps more than the small caps, quite honestly. In terms of the fundamentals, you're seeing better earnings performance and expectations in the S&P 400. Whereas the S&P 600 is still, the fundamentals aren't that exciting. But look, it's when people are excited about buying stocks, you see money going in all areas, and I think they will catch up some.
Well, I'm glad you clarified it a little bit, because it is more nuanced. Because as you know, Lori Calvasina, who was on with me top of our program today, can't get behind the small caps. Says they're too expensive. There's not enough growth. To your point, the fundamentals don't really match where these stocks are trading right now.
Yeah, I think there's going to be a lot of M&A activity. I think a lot of the large caps are going to continue to pick some of the best of the breed in the small cap and mid cap area. And I think banks and technology stocks in those areas may very well benefit from an M&A mania, which I think is still ahead of us now that we've got a new administration that's not going to get in the way of, with antitrust measures, of a lot of M&A activity.
It feels to me overall, Ed, like you're trying to get a little more bullish on this market. And it's not just through the small and mid caps. It's that you're raising your estimates for earnings growth, which you're going to need, really, given where valuations are, correct?
Well, Scott, I've been bullish all along in terms of where it's going. I still think it's going to go to 7,000 by the end of the year. I've had $285 a share for the S&P 500 for this year for quite some time, and that's probably the highest on the street in terms of what the S&P 500 can accomplish. And I'm thinking maybe that number is conservative, or maybe I'll have to raise it, because so far it looks like the fourth quarter of 2024 is coming in better than expected. Analysts were expecting 8%. Now they're expecting 9% year-over-year increase. I was expecting 10%. Now I'm expecting 12% increase in the fourth quarter. So we ended up last year with quite a bit of momentum in earnings. I did think that there might be a pullback, maybe even a correction back in December. I thought it might occur. And we did have a bit of a pullback, down about 4% through January 10th. But last week was quite an amazing week, because all the concerns about the bond market going to 5% kind of melted away. A Fed official said that, well, maybe they will cut by more than 2 times, maybe 3 to 4 times. The inflation came in better than expected, and now with the inauguration, Trump did not raise tariffs from day one, and that was a bit of a relief, suggesting that tariffs will be used for negotiating purposes.
Well, I mean, they could start soon enough. Day one doesn't really tell the whole story. I think the president himself made that point. Now, to your point, Jamie Dimon's message today.
Let me just jump in and just say that just yesterday, I mean, it's a very fluid situation, right? Because Trump was saying 60% on China. Now he's saying 10%. So we got to be flexible in terms of what we're hearing coming out of Washington.
Well, I mean, what he says, what he does, we've already learned our lesson sort of about that. So yes, I got that. Even Jamie Dimon knows, right? It's like, in terms of tariffs, it's like, get over it, right? I guess we'll just deal with it.
We'll deal with it.
And it's not going to derail, though, the prospects of this market?
I think this market's going to continue to be driven by earnings, and I think we are seeing productivity continuing to improve. I think it's been doing it for quite some time. We're back kind of to normal productivity growth. I think we're going to see it possibly double to 4% by the end of the decade. I still think we're looking at a roaring 2020s kind of scenario, with technology boosting productivity, which in turn means record profit margins. And I think S&P 500 earnings will be up to $400 a share by 2029. So I think earnings are kind of let the force be with you. And that's certainly what we're seeing with earnings.
All right. We'll see. Ed, thanks as always. Ed Yardeni.
Thank you.
Talk to you again soon.